Welcome back to the Real Estate Standard Podcast, episode 4 for the week of January 12th, 2026. I'm Tim Kotzman. I'm here with Kenny and Chris. We're going to cover a couple of topics today, including digital income, digital finance, Bitcoin Treasuries 3.0, and Bitcoin operating companies. Kenny, over to you.
Thanks, Tim. We're going to take a quick look at the West Main self-storage dashboard. We have this dashboard here so we can track our Bitcoin purchases, our average Bitcoin price, our P&L, monthly coverages of our mortgage. And just to have a quick snapshot is helpful for us to see how we're performing. Chris, do you want to highlight some of the metrics here?
Yeah, sure. Today's January 12th. We're at block height 932,033 with a live Bitcoin price of 91,288. West Main total Bitcoin holdings is just over 2.2 whole coins. And the total investment over the last 24 purchases is 240,000 US dollars approximately. The Satoshis per square foot is approximately 3,302. That's looks like about a 200 Satoshi change from last week's purchase. So making some good progress there, and you have looks like you got 9.1 months worth of mortgage payments that you can cover here in the event there's a market downturn or some unforeseen set of circumstances. Anything else, Kenny, on this?
Yeah, I think this is just a helpful to get a quick summary of what's happening from week to week. We're trying to build in the public eye, so and be as transparent as possible. So this is a good starting point for us. And then, today we wanted to talk about Treasury companies 3.0, and I'm going to give kind of a Bitcoin Treasury companies 3.0. What I think is going to be the difference between Bitcoin Treasury 1.0, which is Strategy, the original Treasury company, and then 2.0, which could be classified as the Meta Planets and the Smarter Web companies and all the Bitcoin Treasuries of 2025. I think this next wave is going to layer in digital credit. And we've talked about that a little bit before, but it's becoming more apparent that part of the company's reserves are going to go to instruments like Strategy's preferreds. These are going to unlock tax advantages. They're going to increase revenues and strengthen commercial real estate, and I'm sure other sectors as well, but specifically for commercial real estate, it's going to strengthen these properties. It's going to help these new treasury companies be able to stack more Bitcoin because it's going to turbocharge their cash flows. So when you have more free cash flow, you're going to be able to buy more Bitcoin. And yeah, I'm just really excited to discuss that. Oh, back over to you, Chris.
Yeah, I'm excited as well. I think when we started this whole thing, we were really just talking kind of with two different variables: the traditional U.S. dollar fiat strategy that we're all accustomed to, and the second variable being integrating spot Bitcoin into the strategy, particularly from the treasury management standpoint. It's since evolved into collateral and even building systems as well. But now, I think you framed it pretty interestingly there, Kenny, with Treasury 1.0, 2.0, and now 3.0, because these credit offerings, digital credit offerings, are becoming almost a third leg of the stool when it comes to crafting your strategy, your capital strategy around a real estate property, which is incredibly interesting here because these vehicles are they're paying yields that are double that of real estate, probably more in a lot of cases, and They don't come with the same risks or the management intensity that real estate does, and so there's a lot of optionality here. So I've talked in the past about using spot Bitcoin as a treasury strategy or treasury asset, and I've specifically said that whatever amount of your free cash flow you allocate to spot Bitcoin should be more of a long-term savings amount, right? And people have had questions about how do you arrive at that number. There's ways to do that. The what's left over is your short-term operating capital. And now we're getting into a scenario, or we're going into a world where there's a really strong case to be made that that short-term operating capital needs to be held in a vehicle like Stretch, STRC, rather than your U.S. dollar bank account. So there's just the arbitrage is just too great from a returns perspective, particularly in the real estate industry where margins have just gotten absolutely crushed the last 5 or 6 years, and um, owners and operators are really doing anything and everything they can to maintain margins and positive cash flow. So this is a massive topic. I would like to see it get a lot more airtime in particularly the 2026 calendar year. I feel like it's getting a little overshadowed with some of the collateral talk, but it's equally as important, if not more important, and there's a lot of different ways you can approach it.
Yeah, and we discussed last week on X Spaces that we do weekly. We had a guest come on, Grain of Salt. I'm sure a lot of our followers know who he is. If not, you can listen to the recording from last Friday or last Thursday. But we also started talking about where digital finance is going to get involved in with this digital income. I kind of want to back up for a second. A strategy and some of these other companies are issuing these preferred stocks, and Saylor refers to those stocks as digital credit. It seems like I see a lot of comments on X are not putting two to two together here, that the preferreds are the digital credit. Um, and to a buyer, when you purchase the digital credit, it looks more like digital income. So from where I sit as a commercial real estate operator, I don't view it as credit because I'm not the issuer. I'm the purchaser. So I'm thinking of it as digital income. And I think there's a huge opportunity to finance that digital income. So with a physical commercial real estate property, the value of the property is derived through the cap rate and dividing it by the net operating income that the property brings in, and it's given this multiple. The cash flow might be worth, every dollar that comes in may be worth $12, and that's how the property is underwritten, based on the cash flows. And something that happens with the Bitcoin space is the lending seems to be written from the asset price. So that can be very dangerous because it's volatile, and there could be like a flash crash that just wipes you out. You get the margin call, and you lose your Bitcoin. With digital income, it's predictable. It's dividends, but it's really not like your traditional dividends that may fluctuate, because you're able to, with some of these preferreds, lock in your effective yield at the time of purchase, and that yield is not going to fluctuate. So you now have predictable income. That income may be, there may be a scenario where the strategy or the issuer skips the dividends, but there's a few instruments that are cumulative and will be paid back if they're skipped, like the ones at the higher of the capital stack, like STRF, Strife. But trying not to get into the details there too much, this income is predictable, And it doesn't matter if the underlying asset, say Strife or Stride or Stretch, it doesn't matter if they go up or down, and even if they go down by 50%, because the income, the yield that they generate is going to stay the same. And so I think lenders can underwrite on that income. And the question will become, do they treat it, if you're using proceeds from a commercial real estate property to buy the digital income, well, how is that income going to be treated? And is the lender going to let you borrow it at the same terms as the physical rents are derived?
Kenny, let me jump in here, try to bring this back to the real estate here, because if we're talking to the real estate operator, right, we need to, as far as making this digestible and manageable for them to understand, right? If you're a real estate operator, you're always looking at ways to activate different areas of a property. That's one term, or monetize, right? Some examples. Maybe you put some solar panels on the roof, right? There's a diversified revenue stream potentially. You put a cell tower on the property, another revenue stream, right? Above and beyond your typical rent roll from your tenant income. Some properties will charge for parking. That's another revenue stream. There are properties that if you allow people to put vending machines or other types of amenitized components, you as the landlord, that is not your core business. You outsource it to a third-party vendor. That vendor then pays you a fee each month to have their vending machines there. Right now, bring it back to what you're saying with, I like your the way you framed it as far as your digital rent, right? Because that's the meat and potatoes here. The digital rent component is another income stream that is arguably uncorrelated to the local real estate market. So from a real estate operator's perspective, it's a diversification tool, and it's allowing you to um, hedge any local market risk while also increasing the profitability of the asset or the portfolio because of the yield component that comes with the digital credit.
Yeah, no, thank you for simplifying that and breaking it down. And the point being is that when you have that vending machine income, or you have that cell tower income, or you have that billboard lease income, when you have these parking spaces leased up, um, the lender normally doesn't discount that income. They're not coming around and saying, hey, your core business is retail shopping or self-storage facilities, and this is out of scope, and we're going to discount the rent. But I haven't seen any lender out there yet willing to underwrite the digital rents that I'm referring to. And so I think that's a huge opportunity, because as soon as you buy the income stream, as soon as you buy these digital properties, these preferred digital credit instruments, you're buying a cash flowing property from day one. You don't have to lease it up. You don't have to go market it. You don't have to find a property manager. It starts spitting out cash on the first month. If it's Stretch, which is paid monthly, or if it's one of the others, it's paid quarterly. And so the question becomes, well, normally with a real estate deal, it takes time to do that, to stabilize. And then you go back to your lender and say, hey, we stabilized the property. We have more equity built up. Our debt service coverage ratio has gone back up. We want to tap the equity and pull the cash out to go buy another property. And they say, okay, let's run the numbers. With the digital credit, you can do that every day, every week, every month, every quarter, every year. It's going to come down to the frequency at which you can refinance. So typically with commercial real estate, it's once a decade, twice if you're lucky. I think the future are going to be like these revolving credit facilities or these newly structured finance deals where you can reevaluate on a weekly basis or a monthly basis. It's going to be dependent on what the lender is comfortable with. Maybe it's quarterly at first, maybe it's annually, but it's going to be a huge. I mean, we have lines of credit now, but they normally have a cap, and there's an appraisal that happens, right? And that dictates the cap, and it's not reappraised or reassessed every month. So I'm
So
getting bullish.
let me
Yeah.
ask you a question here, Kenny. So where you're going with this, I mean, and this is actually kind of timely because of the um, what's been just inundating my Twitter feed all day is the recent Saylor interview on what Bitcoin did and the pushback he gave Danny on his Treasury question. And if you continue to do this, if you're accelerating the refinancing timeline, right, in this real estate world slash digital credit, it sounds like you're getting a lot further away from the real estate operation than you initially, found yourself in. So if that's the case, question one, is that what you're referring to? And two, where do you go from there? Right? Are you using this accelerated cycle to buy more properties, or are you just using it to accumulate more Bitcoin or more shares of some sort of equity? I think that's where I'm kind of getting lost.
Well, I think, like, yeah, we got to back up. First, this is only possible if you have the commercial real estate, right? Because without the commercial real estate, you can't get the long-term financing unless you have a publicly traded company, or you're dealing with venture capital, or you have a really fast-growing business. So the commercial real estate is the foundation of the digital property. You can't you can't support the digital property if you don't have the physical property first.
Okay,
Because
I follow you.
because you're basically enhancing the property. So the question that you asked me, like, if I reverse it, you're saying, are you going to stop enhancing the property? Are you going to stop making the property perform better and better? Like, is there a point in which the property performs well enough in which you're going to stop the curb appeal? You're going to stop the operations. You're going to stop the efficiency. You're going to stop the digital income.
Well, the nuance there is what are you doing with the increased income, right? If you're using the increased income to just go buy, more digital credit and hyper financialize the real estate asset, that's one approach. And sure, you may improve the financial returns in the short term because of that. But if you're not utilizing the increased returns to improve the property, to re-tenant the tenant base, to be a real estate operator, then it's only a matter of time before that real estate property falls into disarray and your money machine goes kaput. So I think we need to be just cognizant of the fact that with this increased return, with this increased cash flow, what are you doing with it? How are you storing it, right? The easy answer, the easy out is I'm going to just go buy more Bitcoin. I'm going to buy more stretch and, sit on my hands. That I don't think is a good plan, right? I am, and this is the real estate guy in me, but if you're going to have these outsized returns, you have at least today, a first mover advantage that enables you to rewrite the entire playbook. And the second and third order effects of rewriting the entire playbook are um, profound, to say the least. So, if you're a real estate person listening to this and you're kicking tires on Bitcoin treasuries, standards and strategies and digital credit and how you can integrate it into the real estate property to improve it, that's once you have that improvement, that improved yield, what do you do with it? right? I want to see people use higher quality materials and finishes on their tenant improvements. I want to see more proactive efforts on capital expenditures in the common areas, making sure that roof is up to speed, making sure that the different areas are activated that should be activated to create a high quality property. And the answer to what those particular areas are or how you approach that varies from property type to property type. But and that's where property specialization comes in. But depending on your situation, you need to use those increased returns in a constructive way that ultimately comes back full circle to the real estate property. Because then once you have higher quality materials and finishes, tenants are going to want to be there, right? The property is going to be in higher demand from the tenants. You're going to have pricing power as a landlord. The consumers are going to want to visit it. It's going to have this feedback wheel that positions that asset as the premier asset in said market, whatever that is. And once you have that, then it's easier. You can scale the portfolio, like you're saying, once you've accomplished some, I don't want to say critical mass, but some level of high quality operations.
No, that's well said, and I'll just clarify because maybe I didn't answer like what you do with the cash flow. Well, you do whatever you want with the cash flow, and obviously you're going to have um, your big capex expenses covered for. That's just like, I'm kind of glossing over that, but you have to be a well-run property manager and operator like you described. You have to make sure your parking lots don't have potholes and liabilities in them, and you want to make sure your roof isn't leaking, and you want to make sure the paint is fresh and there's not a bunch of garbage on the. You want to have good curb appeal. You want to have the property taken care of. You want to have up to date HVAC equipment. You want to make sure the building's sprinklered, or you want to have these amenities, and you want it to be up to snuff. And so the the way that I was alluding that you could finance the acquisition of the digital property that would derive digital income. um, you're purchasing that by that flywheel effect is coming from the value of that cash flow. Now you can still reinvest that cash flow is increasing. So this means you have more money for improvements. You have more money to buy Bitcoin. So it's not like you have to kind of decide, well, do I set all this money aside for an improvement that might come up in 5 to 10 years? You can put it into a number of things. You may want to have a USD reserve at some point once your digital rents become equal or greater than your physical rents. You may want to have different buckets. You may want to have stretch. May want to have strife in case payments are missed. So you have like the cumulative payment with strife. It's more senior. So you're hedging against that risk. But the question of what do you do with that additional cash flow? You At some point you can acquire more real estate if that's what you want to do. And the way that I would do that is by borrowing against the Bitcoin. So once you grow your Bitcoin to a certain level, you can add a credit facility on that Bitcoin, use it as bridge financing, short-term financing, where you go acquire the property cash, and then you get it up to snuff, you stabilize it, you do the improvements, you have the capital, and then you refinance it again with a lender, and then you can purchase digital property for that building to to boost the cash flows, to improve the overall property. So it is complicated, and there's multiple layers to it. And I've been just surrounding myself in this stuff, and I might talk a little fast, so it's I'm happy to kind of go and rewind. And it's easy to see, like you could say the same thing with the Bitcoin, right, Chris? Like you could say, well, at a certain point, after 10 years of dollar cost averaging, say, forget the digital income. right? Just say you're going to stick with a simplified approach and you're just going to dollar cost average. What happens when your Bitcoin's worth more than the property? I mean, are you going to sell the Bitcoin to go buy more real estate? So, I mean, you can flip that on its head too. I think the answer is that you cannot have this digital property flywheel without first owning the physical property. That's step number one, is to have some real tangible real estate,
Hmm.
lease it up, make it cash flow positive. And then when you're looking, what else can I do to enhance it? That's when you add solar panels. That's when you go lease the roof space as a billboard, or you lease the extra parking space. You start trying to, you had a good term for that. What was it? You start to activate the property. And
Yep.
then you activate the digital rents. You can't do the digital rents and then try to do this flat. There's going to be no lender willing to lend to you, because you just have a dividend paying stock at that point. You don't have the underlying asset that makes it all work.
Yeah. And your earlier comment, I think I don't know this for certain, but I would put money on the fact that no real estate investor, operator, fund is thinking about digital credit at this point. We they are still trying to digest spot Bitcoin and what the heck that means. So yeah, we'll see. But on last week's Twitter Spaces, with some of it sounds like you were having some challenges finding banking relationships that would look at the refinance, or look at some of these creative solutions you were talking about or exploring. And the takeaway there was making sure you found the right lender profile, right? It's probably a community bank that's going to be your best bet for something like what you're describing. Those are the ones that are going to be taking a more holistic and comprehensive view of your situation, and making a credit decision on the request.
Yeah, you're right that there isn't a product out there. I think the beginning of this episode, I briefly touched on, the wider, I don't like to use the word, but crypto market has had a lot of lending products that have failed tremendously. And what I'm thinking is, this is a whole new way to be able to finance exposure to Bitcoin, because it's off the cash flow. It's not off the underlying asset. So it removes the volatility aspect from the equation. You don't have to worry about, is you know is Bitcoin going to go up? You don't, like, if Bitcoin goes sideways or down or whatever direction it goes, you still have this dividend income, because you have a company that's willing to take the longer term bet, right? They're willing to hold for 10, 20, 30 years, and they'll ride out that volatility. And in exchange, they have no ceiling, right? They can get um, unlimited gains, essentially, if the underlying asset were to go up, where you're capped at a fixed, predictable monthly income. And so you just have this option that didn't exist before. These preferreds are all new, and even some of them have been around for a year, but it wasn't until um, I think the USD cash reserves with Strategy made it comfortable, where a real estate guy could look at this and feel confident that he's going to get the dividend payments every quarter or every month. Now that the cash is sitting there in a bank account specifically for the dividend payments. It wasn't like the cash was raised to go grow the company, or just to operate the company. They didn't need the cash sitting there. They got the cash specifically to pay the dividends. So they've de-risked this to a point where it's any lender that starts to really put eyes on this, they're gonna have like an aha moment, And I think there's going to be all sorts of innovation in digital finance because
I don't disagree with you there at all. I think we're in the first innings of the innovation taking place here, but I still think the real estate community, residential or commercial for that matter, is still trying to understand how Bitcoin, let alone digital credit, helps them with their real estate. Because the biggest pushback we're going to get, or what I get at least, is, if you love Bitcoin so much, why don't you just sell your property and go focus on that? Right. And for some people, that is the right decision. But for those that, real estate is their core business, it's, maybe it's a generational business. They've spent 20, 30-year career in that space, whatever it may be. That's what they know. That's what, they get out of bed every day for. We need to focus on those people and help them understand how these new tools improve and complement the real estate asset. And I don't think you bridge that gap by talking about all the creative financing options at this point. I think you talk about the basic, boring things. What is that? That is, the ability to grow your purchasing power, and at least maintain your purchasing power, if not grow it, right? Would I use digital credit for that, or would I use spot Bitcoin? That's an answer that operator has to figure out for themselves. If it's me, I'm going to be using spot Bitcoin because it's going to be a longer term horizon. If another tangible solution is building and maintaining reserves for your maintenance, your emergencies, your capital expenditures. Um, Another example is just to mitigate the rising operating costs. Most real estate investors are underwriting somewhere between 3 and 5% annual growth in the OpEx. I can tell you right now, particularly the last 6 years, the annual growth in operating expenses is well beyond 5% per year. You add together, and you know this, Kenny, right? Just operating your own asset, electrical, insurance, water, sewer, trash, maintenance, like the whole thing. It is exceeding a 5% annual growth rate. So that is a tangible, practical issue that these operators are dealing with, and they're trying to figure out how to solve for it. And that's where digital credit comes in. If you want something safer, more stable, more predictable, you should be looking at something like STRC, right? Because of the characteristics, versus spot Bitcoin. But and I'd be remiss if I didn't say, another one of the use cases for this strategy, which is right up your alley, Kenny, is the credit worthiness component, right? In the future, ability to refinance and scale the portfolio through the collateral angle. So there's a few companies that I'm aware of. I mean, we all know Cardone Capital. He's pretty loud online with their treasury strategy. I'd like to see them share more details on, how it's structured, what the splits are to each party, and how it's being custodied, all that stuff. Caruso Properties is a major retail and apartment landlord in Southern California. The main guy's name is Rick Caruso. He actually ran for LA mayor last cycle. They put Bitcoin on their balance sheet and implemented a policy that tenants can pay rent in Bitcoin back in 2021. The real estate community knows Caruso Properties. They are a well-respected, well-known operator in the space. So from my vantage point, that's incredibly exciting and incredibly encouraging. In the hospitality space, there's a company based out of, I believe it's Mexico City, publicly traded operator called Murano Hospitality, Murano. The founder CEO is a Bitcoiner. They have a certain percentage of their reserves in spot Bitcoin, and they're implementing policies, particularly in their rewards and loyalty programs, to allow the consumers and their clients to utilize Bitcoin there. So um, as real estate operators, if we can start pointing to some of these, more household names, Cardone, Caruso, Murano, West Main, here's what these guys are doing. This is the strategy that they, decided was the right fit for them, right? Now it becomes a lot more of a manageable conversation with the real estate community, because I still think Bitcoin is a dirty word for in a large part of the community. The last thing I'll say on it is River, the Bitcoin exchange. They put out a report last year on, particularly from their business unit, and real estate was actually the top industry of clients they were onboarding. So those are privately held entities. They're the West Main storages of the world. They're brokerage companies. They're property management companies, and just to see the real estate industry at the top of that list, as far as the businesses that were being onboarded to a Bitcoin exchange, is incredibly encouraging, that we're leading the pack. So
Yeah, there's a few things I wanted to comment on. You mentioned kind of like getting back to the basics, so to speak, like start off with just buying Bitcoin or accepting Bitcoin. And I'm trying to kind of like think a little bit in the future, and I could see where digital credit becomes step number one, like digital income becomes step number one, and it's less risk. I think it's more relatable to an operator. First off, you got Bitcoin, which is long term savings. So it's not going to generate any cash flow. It's going to just appreciate. And often with real estate, the reason why the operators are there is for the cash flow. So when you start speaking real estate operator language, cash flow, digital rents, digital income, I think that's much easier for an operator to relate to than Bitcoin. They hear Bitcoin, like you said, it's a dirty
yeah,
word, it's scary. They don't want to, risk it. But if you tell them, hey, you can create digital income from your property, it's digital rental income, then they're more ears. Um,
they
the
perk
other
up.
thing is, yeah, the other thing is Bitcoin is, like I said, it's like a longer term savings. It's more to protect your wealth. You're trying to save what you've already earned. You don't want to feel like you have to go out in the world and keep buying real estate, doing 1031 exchanges, and there's no stop. You just have to keep building and building and building. You eventually want to break, but you come to the realization you can't afford to sell, that you have to wait until you die, pass the assets on to your children so they get a stepped up basis, and maybe they will decide to sell or operate the real estate. So you're stuck in this rat race, so to speak, where you have to keep developing, keep building, and keep leveraging your properties. These digital rents allow you to kind of take a break. It's like, hey, you know what? We don't have a deal that we want to do today. Like we just built something last year. We want to cool it, but we don't want our cash to be, the depreciating, or our purchase power is getting destroyed by 8% inflation year over year, or whatever it's at. So you feel like you got a fire under your butt to keep moving. Um, so this allows you to diversify into non-tangible real estate, in which you can collect cash flows from day one. You don't have to go find the deal. You don't have to go build the building. You don't have to go find the tenant. You don't have to stay. It's like giving you a break, and it's simplifying the cycle where you have to kind of build, refinance, and repeat. So I think that Saylor has mentioned that Stretch is simplified messaging for those who like money, right? It's like you don't have to explain Bitcoin. You just explain it's a 10% yield. Um, so this kind of like cuts to the chase for a lot of people. They get to see like the direct impact that their cash flow is going to go up, and then they can kind of work backwards. It almost reminds me too, when I first um, got involved with Bitcoin, the Lightning Network didn't exist. And when it first came out, users would onboard to on-chain Bitcoin and then to Lightning Bitcoin. Lightning Bitcoin was like a more advanced kind of way to use Bitcoin. Today, it is the onboarding part. Like
Yeah.
when I onboard somebody, you onboard them to Lightning. When they get more interested, and then you get them onto on-chain. So I think this could be an easier way long
Yeah.
term. So I just
That
kind of wanted to play
No,
devil's
that's
advocate.
those are very fair points, and I'm glad you said what you said there as far as the the hamster wheel, so to speak. I mean, and this is why I keep pounding the drum on it too, because if you're a real estate operator not getting on this bandwagon, you're not implementing this strategy, you are going to be on that hamster wheel in perpetuity, right? And you will never be able to slow down. You will never be able to enjoy the fruits of your labor. Maybe your kids will when you pass on a stepped up basis to them, but you won't, right? So that's point one. Point two, which you astutely pointed out, is the ability to be more selective on deals, right? And that I don't think that gets talked about enough in our industry. And I mean, this is actually I have a big bone to pick with this just in general because it's an example of misaligned incentives, and the Bitcoin community knows this inside and out. As far show me the incentives, I'll show you the outcome, right? Real estate commercial real estate funds, I mean, and acquisition guys, they the way that it's set up is they get a certain amount of money, for a year or for a fund. If they don't spend that money in a particular period of time, not only do they lose it, but they don't get their bonuses, right? So when you're in that seat and you have to go, spend $100 million building a portfolio, deploying capital for whoever your clients are, you're just going to make deals to make them, right? It doesn't matter if the underwriting makes sense or not. You're not putting any kind of rigor into the diligence process, or maybe not as much as you would otherwise. I don't want to say you're not doing diligence, but you're not being as selective as you could and probably should be. So, bringing it back to your point, Kenny, if you have the ability to be more selective and pick and choose deals, not because you have to, but because you want to, now you start to build out the industry and the entire real estate asset class in a much more robust and anti-fragile way, right? I mean, that is the change that we're ultimately going for here. That is going to be again profound and withstand the test of time, right? You get cycles. The real estate is cyclical, right? There's no hiding that. We all know that. But the cyclicality, the downturns, the booms and busts, in that world, we are the peaks and the valleys, the peaks and the troughs are not nearly as sharp. And I think that's a good thing for everybody in the industry, regardless of what role you play: passive investor, active investor, fund manager, broker, what have you. Um, so I think the selectivity on deals is underappreciated. And the last thing I'll say here is when we go back to talking about the basics, and I feel like we ping pong between the Bitcoin side of our brain and the real estate sides of our brain. And the I think the word treasury has just become so convoluted that and means so many different things to so many different people that it actually detracts from the ultimate goal here, right? Just because I mean, at some point, every business in the world is going to hold Bitcoin. Does that make them a Bitcoin treasury company? Probably not, right? But if you're a Meta Planet or a Strategy or 21, and you're issuing products on top of it, okay, well that's fair. That's a different type of business. They have their own niche and their own specialty. So I don't have a good answer for that one yet, other than just, kind of putting it out there for, future discussion. Is, the whole Treasury moniker, I think, has just been blurred too much, and particularly for the newcomer coming in, where they're like, "Well, Treasury strategy, what's going on?" I think it just makes that leap that much harder at the end of the day. So I think we have some work to do there from as an industry and as educators. What that actually means. Is it, what role does it play?
That kind of brings me back to how, like, in the dot-com era, where all the companies were tech companies, and
Yeah.
then, like, at some point every company was a tech company because they had a website.
Slap .com on the name, and they garnered what, a couple hundred million extra dollars in value. Now it's .ai.
Yeah. And so I mean, I think that, that was like the start of this, digital cyberspace, right? Because the domain names are the address to your property, essentially, and your website is the contents on there can be like the billboard for your physical property, at least in the real estate space, right? You have a self-storage company, you have a website, here's our pricing, here's our address, here's information about us. And this is kind of, the next evolution is where you're like able to kind of monetize that digital space, because you can have like a piece of land in cyberspace. That's what the Bitcoin represents, and then the digital credit can be that building on the land that we've discussed on the previous episodes. So it's really an extension. And so, now the joke is that we're calling them treasury companies, but every company will become a treasury company, because every company is going to want to have some digital land, and they're going to want to have a digital building. If you're a restaurant, even a lot of restaurant owners like own the property because they realize that their biggest expense is the rent. So they realize, oh, I should go build my own building. That way, like I make all the money by saving, by paying down the mortgage, and building equity in the property. And so is the restaurant a real estate company at that point? It kind of is, right? So, like, the lines get blurred all the time, and I think it's just kind of going to take some time, like you said, before digital rents catch on. But they are, while they're intangible, they're tied to the property. They're tied to the cash flow of the property. They're tied in, and they're all intertwined. So to kind of finish up today's episode, Bitcoin Treasury Companies 3.0, I think that the biggest criticism over the last wave of these companies were there were some pure play Bitcoin treasury companies, and the mainstream investors didn't like the fact that their cash flow or their income or whatever appreciation they were gaining was being derived from financial engineering, and that they wanted to see actual cash flows. So I think this having these digital income streams is the answer, right? If you can allocate a portion of your treasury to have these digital income streams, that can be used to pay salaries, that can be used to pay operating expenses. And I know that we're the real estate standard, so we're not dealing with strictly pure play Bitcoin companies, but I think that this all ties together, and um, the cash flow has been the missing piece, and now there's a few companies solving for that cash flow, whether they're they're doing it knowingly or not, right?
I've said this before, I'll say it again. I mean, the thing I love about commercial real estate is seeing and understanding all the different ways that investors and operators develop their strategy, right? there's so many different ways to make money in real estate and so many ways to make a deal make sense. And you now layer in this the Bitcoin standard, the Bitcoin strategy, and then you start layering in this digital credit, this digital rent. I like the way you frame that one into the conversation, and it just expands the realm of possibilities for real estate and how you can utilize it to your advantage. And you don't need to be the you don't need to be the real estate operator that is doing everything Bitcoin, right? The spot Bitcoin, the STRC, accepting Bitcoin rent, integrating Bitcoin mining into your mechanical systems, doing the dual collateralized loans. You don't have to necessarily check all those boxes to be competitive and profitable. This is where the situation becomes so important, because there's going to be properties, there's going to be scenarios and markets and product types that are only going to warrant some of that. And I have no doubt that the real estate community is going to be able to get their arms around this and develop strategies that are specific and relevant to each property type and each individual market for the set of circumstances that they're looking at. So I'm incredibly excited is the long-winded answer.
And that'll wrap us up for episode 4 of the Real Estate Standard Podcast. Thanks everyone for watching and listening, and we will see you back here next week.